Hello and welcome. You're watching us here on Halftime Report. I'm Manglam Malu. With me, Ekta Batra, Sonia Shenoy will join us in just a bit. Not looking too bad for the markets, sitting around that 17,750 mark. We opened well and we've held around those levels. So looks good so far, so good. The only contention is that the second half of trade, we have the weekly options expiry kicking in. And it is these very levels, 17,030 to 17,730 to around 17,800 thereabouts, where we've retraced in the, from these levels thrice in the last 3 weeks or so. So let's see what happens in the second half. But really, this afternoon, no complaints, Ekta.
Yes, absolutely. We have the Bank Nifty, which is higher by around 1.5% at this point in time. We have the mid-cap index, which is up around 0.4% as well. Lot of stocks which are buzzing around. And from the broader markets, we have a lot of the healthcare, pharmaceutical stocks which are higher. So something like an Aarti Drugs, which is up around 5.5% Metropolis, which is up around 5%. Even a couple of these banks which are doing well today. So Bandhan Bank is up 3.5%. IOB, Karur, all of these stocks gaining anywhere between 2 to 3% So it seems as though there is some kind of differentiation from us versus the globe. Remember that we do have a lot to reckon with in terms of macro data in the next couple of days as well. We do have the CPI data for the month of August, and that's probably expected to be a sub 7% figure for the second consecutive month. And that should probably boost sentiment as a whole. And probably the fact that, Brent is below $90 per barrel, Manglam, obviously always aids the macros and sentiment for us.
It does. So let's talk about the micros now, that the macro sentiment and the positives out there have been spoken about. And one of the micros are one of these stocks that we're looking at, that's Speciality Restaurants. Remember, these are the guys who run the mainland China, etc., sort of restaurants, Calcutta. The reason why we're talking to Anjan Chatterjee after a very long time actually is it has been buzzing, the stock. This year itself, from the start of this year, just pull out a 6-month chart or something, it's up 150%. This month it's up around 8%, but that doesn't tell you the entire story, because this month we've had just a few trading sessions, but this stock has been buzzing on big volumes. The market cap has crossed 1,000 and the stock has hit a fresh high. There you have it. Almost 62% gain coming by in just the last 6 months. Anjan Chatterjee joins in. He's the chairman and managing director. Anjan, it seems like after what was a tough 2-year period for both the hotel as well as the restaurant industry, things are coming to some sense of normalcy and something better than normalcy, so to say. For you in particular, I just wanted to understand, what is it that you learned from COVID and you've guided now so that your business has moved to a different trajectory? Because pre-COVID, you never made profit for the last, I think, 7 or 8 years. I'm looking at data for the last 7 or 8 years. And FY22 was when you made an entire year's profit of 8 crores. And the first quarter itself, you made 15 crores in terms of profits. What is it that has changed, and is this sustainable?
As I've been quoted many a times, because, COVID has been the biggest possible teacher. And as you understand that when you run a restaurant company which has so many of these brands and also the kind of penetration you have, you actually understand that you're going to be making and balancing the profitability at one point of time. And then there have been fence sitters over a period of time who were not making profits, and we were about to, shut them one by one. But COVID came in, we were against the wall, and we had to shut them off in one go. So everything which was not profitable was shut out, and the profits came back to the company. That's one of the pillars. The second one was, we never realized the potential of our deliveries, the vertical of deliveries, because we are primarily a dine-in restaurant. When COVID came in, it was 100% delivery to start with. And as we speak about this month, we are at 27% of the total turnover, which is delivery. We had to go back and work things out all over again, get into the packaging, the logistics, the hygiene, which we are very, very particular about. And here comes in a new vertical. So we started sweating our assets, which were all there inside. But then deliveries become a new norm. And it's a new normal because the fact that the whole, COVID period, as the OTT came in, the deliveries came in as a reality, and they're here to stay and grow. So
I'm
these,
just
asset sweatings of making our kitchen work harder,
Sure.
putting 2, 3 brands actually, gave us a fillip. And then I think going forward, there are many more learnings which are coming in to ensure that we try and keep this kind of a performance.
Sure. Anjan, so it seems as though you've slimmed down and you've sort of channelized your strengths towards certain verticals. Does that change your capex plans? Because you said that deliveries is basically what you're focusing on now, or has become, an integral part of the business. Is that going to be changing your capex plans? Your fresh new restaurants, which you're probably going to start, might now be on the back burner because you think that it's probably more lucrative to just concentrate on deliveries. How have things changed structurally for you as a business, as a capital expenditure going forward?
70% of our restaurants are, doing the deliveries from the restaurants because we've actually started sweating the assets within them. That's kitchen within kitchen. Now we've started adding cloud kitchens in the areas wherever we were not representing or we have withdrawn from. You see, mainland China continues to be, with God's grace, the #1 brand in the Oriental space. So there is a demand because people have been talking about cloud kitchens coming in. So it's going to be a hybrid model coming together with the restaurant and the brand which will be on cloud kitchen. So the capital expenditure which has been planned for the year, we've had a cautious opening plan, but we are definitely going to be surging ahead with our plans, but not in a hurry because we see a cloud kitchen giving us great returns vis-a-vis a new restaurant being open. But there is no way that this is not going to be the, futuristic plan. We will use our, as you know, we are debt-free and we have respectable money lying. So there's a clear understanding that we'll be opening at least within 18 months, at least 3 to 4 restaurants planned with areas where we are not geographically present. So there's going to be a hybrid model. And of course, there'll be this 30% which we have today coming in from kitchen within kitchen and the cloud kitchen, which is giving us profitability. We will continue to focus and surge ahead with these two verticals working parallelly.
Okay. Mr. Chatterjee, good afternoon. This is Sonia here. I just wanted to ask you a little bit about what the footfalls have been in Q2 so far. The numbers, if you can share with us. Have they improved compared to what we saw in Q1? And what is the expectation for the full year?
As you know, I can't give you the forward-looking numbers, but footfall-wise, the surge ahead continues. But this is, the first 2 months have been very good, respectably good. But in the month of September, as you know, that there are so many of these festivals, Ganpati, then you have internally, there'll be a Navratra, etc. So there's a bit of deflection. September historically has not been the best month, but I continue to see footfalls growing. I continue to see deliveries growing, even if it means that people can't come in to the restaurants, and so we get the delivery. So there has been a respectable set off. But, we are not a quarter company. We continue to believe that, we have to surge ahead in the coming short and mid-term. And in the long term, we have stayed back in spite of the fact, yes, you're right, that we've had bad months and bad quarters earlier on. But now onwards, there is a lot of understanding of the balance. You can clearly understand the hybrid model works very well because the tailwind that we have got, and the footfalls will continue to be better because Q3 is going to be the best quarter because the festivities coming in October, November, December. And also we are seeing that, September to September, there's been a...
Right, we take that point, Anjan, and we're happy that, things are coming back. We're only happy to visit restaurants and eat good food while ordering in as well. Final question before we let you go. You said you've had bad quarters, bad years in the past. Well, 2012 is when your IPO came at 150 rupees a piece. And now as we speak, 10 years later, the stock price, after a big rally, is still at around 225 odd rupees. Not a great sense of return that, investors have got here. You started out as an advertiser, then got into restaurants. You had some bad years with regards to over-expansion, etc. Now that things are right, at any point, are you looking to exit this business, maybe sell to a bigger player who might want to, benefit from the brands that you have created? or maybe keep this within the family fold?
You see, I don't want to be a baker in life because, I really don't know. I've only learned restauranting and I have a passion. And I think I'm still agile. My company, my colleagues have still kept me. My board has continued to be believing in me. So I don't see any reason of this being considered at this point of time.
Okay, all right, Anjan, we're going to leave it on that note. Thanks very much for joining in and talking to us. And I'm sure whenever we do get a chance, we are definitely going to swing by at one of your restaurants. Stock up around 4% at this point in time. Deliveries picking up for the company. Take a short break. When we're back, we're going to be talking about Rakesh Gangwal selling around 2.8% stake in Indigo Aviation. Stay tuned.
Welcome back to Halftime Report. Let's focus on Indigo now. The co-founder and former director Rakesh Gangwal sold a small 2.8% stake in Indigo Aviation. So let's tell you a little more about that. Now, the Gangwal family has begun selling their stake in Indigo. This is 7 months after stepping down from the Indigo Aviation board and stating that he would sell his entire holding over a period of 5 years. Co-founder Rakesh Gangwal and his family have now finally begun the process of selling their stake in Indigo. Now, the Gangwal family today sold 2.8% stake in Indigo, and this is for 2,000 crores. Remember, co-founder Rakesh Gangwal and his wife Shobha Gangwal together own 23% stake in Indigo as on June 2022. Now, the Gangwal family and the trust cumulatively own a little over 36% stake in the company. Rakesh Gangwal had earlier indicated that he would sell his entire holding over a period of 5 years, and the stake sale was possible after the modification in the Articles of Association, which allowed the sale of shares by promoters without seeking approval from the other promoter. But what this does is puts to end years of dispute between the promoters. Post the stake sale, Gangwal's holding will be down to 33.8%, while Rahul Bhatia, the other co-founder, will continue to hold 37.8% of the airline.
Okay, all right, Sonia, thanks very much for that. So that's on Interglobe Aviation. But we have another stock in focus. Bharti Airtel has been gaining post what was a big block deal yesterday. Reema's here to tell us more on the stock that she's tracking. Reema.
Thanks so much for that. So yesterday there was a 1.8% block deal which took place in Bharti Airtel. The seller was Singtel and the buyer was Bharti Telecom. Bharti Telecom is jointly owned by Sunil Bharti Mittal as well as Singtel. Now, this news comes on expected lines because Singtel in August, towards the end of August, had indicated that they want to sell a 3.3% stake in Bharti Airtel, which will be acquired by Bharti Telecom because they want to equalize their stake. They had said that in the next 3 months they will sell this 3.3% stake to equalize the stake between the Sunil Bharti Mittal family as well as Singtel, and a part of that has played out of 1.8%. There is still a balance, 1.5% stake sale that Singtel is still likely to do. Now, this is an inter-promoter transfer. Both Singtel and Bharti Telecom are promoter entities. So this is an inter-promoter transfer which took place yesterday, which is why there is no overhang on the stock, and the promoter shareholding remains unchanged at 55.3%. Back to you.
All right, we take that point. Thanks a lot, Reema, for that. That's about Bharti Airtel, sitting with a gain of about 2.5% in today's trading session. We have some news on TVS Motor launching the TVS Apache RTR 160 at about 1.6 lakh and 1.16 lakh and 180 at about 1.3 lakhs. So new launches coming for the two-wheeler maker as well. Enough of SUVs, I guess we speak about.
And this is a commuter bike.
Yep.
So it's in that segment which has not really done that well, right? I mean, this whole mass market segment is something that has been struggling, especially two-wheeler mass market. So let's hope that with these new launches, they come back.
There's one person who's not going to buy them, and that's me, because I've never been allowed to buy two-wheelers. But we'll talk about that in just a bit. Let's move on to a CNBC-TV18 exclusive. Sources tell us that the IRDAI, the insurance regulator, has dropped the proposal for mandatory disclosure of commissions on policy documents. Yash joins in with details. Yash, what does this mean?
Well, very recently, CNBC-TV18 had reported that the insurance regulator IRDAI was considering mandating insurance agents to disclose the commission which they receive on each policy on the policy document itself. The latest that we've been given to understand here is that after facing a stiff resistance from the largest life insurance company, that is LIC, as well as the agents community, the insurance regulator has decided to withdraw this particular proposal as of now. The thought after a wide consultation that was formed at the insurance regulatory body was that insurance agents are very crucial at this stage for expanding the distribution, for taking the penetration higher. And if this proposal of mandating the insurance commission and disclosing them on the policy document is brought into regulations, then it will discourage that entire agent community, impacting the business negatively for the industry, for a lot of insurance companies which have a large dependence on insurance agents for the distribution.
Okay, all right, Yash. Thanks very much for that detailed analysis. We need to take a short break, but a quick reminder for our viewers as we do that, it's that time of the year again. Money Control Pro's financial freedom offer is back with added benefits. Get a Money Control Pro subscription at net zero cost by claiming exciting offers worth 1,500 rupees from our partner brands. Grab the benefits now only on the Money Control app or website. Welcome back. Well, steady day for the market, so no complaints coming in. I'm tracking one particular stock today, however, from the Nifty space, which is Dr. Reddy's. In fact, we have been covering this since yesterday, where, the buzz was that Dr. Reddy's would probably be launching Revlimid generic, and that is exactly what they've done. They've launched the generic version of that particular drug in the US markets. Remember, it's a blockbuster cancer drug. It did sales of over $8 billion in the US alone before it was genericized. It did get genericized in March of 2022 when we did have, companies such as Natco as well as Teva, which launched the first generic version of that drug in the US markets. And now it's been 6 months since then, and Dr. Reddy's has now been able to launch all 6 versions or strengths of this particular drug. But why does Dr. Reddy's stand out? Because they have exclusivity on 2 strengths, which is basically the 20 mg as well as the 2.5 mg version of this particular drug. What this means is that for this next 6 months, Dr. Reddy's would be the only other company besides the innovator which will be able to sell these 2 strengths in the market alone. So that would probably give them a bit of an edge as compared to the others, which will only be able to sell the other strengths in the market, which include the 5, 10, 15 mg. And we are expecting much more competition there. But remember that these 2 strengths is only around 10% of the market. But Dr. Reddy's could rake up anywhere between $500 to $600 million in the next 3 years from Revlimid generic, according to analysts. However, this is obviously based on competition. This is based on the offtake of the drug as well. But nonetheless, in the near term for FY23, the street is anticipating that they can probably make around $50 million. FY24 wrap it up to $140 to $150 million. And FY24 edition could be around 35 to 45 rupees. There is also a note on Dr. Reddy's today. Morgan Stanley has written on it. They have an overweight call with a target of 5099. They say that they expect a gradual ramp up in the biosimilar business of Dr. Reddy's. So that's what's making them positive at this point in time. We also have a couple of other brokerage calls in the pharmaceutical space. CLSA has written on Syngene. They have a buy with a target price of 750. They expect earnings doubling over 3 years, making it a double bagger. And Syngene is near an inflection point, according to them. And Morgan Stanley is also written on Biocon. They have an overweight with a target price of 465 rupees. So that's a whole host of pharmaceutical stocks in focus.
That is.
All right. So Syngene, Biocon, Dr. Reddy's all in focus. But let's move on and talk about a Bloomberg report that states that China is buying LNG from Russia at half the price. Sonal is here to give us more on that. Sonal, over to you.
Well, a lot of interesting things are happening as far as the global gas economy is concerned. At one place, we are seeing gas prices in Europe touching record high levels. They are up anywhere between 500 to 700% in just last 1 month, 1 year. And that has happened more so because of the Russia-Ukraine crisis. And now Bloomberg report suggests that China is sourcing Russian LNG and it is coming to them at half the price of the spot LNG prices that we are talking about. It is via that Sakhalin 2 LNG export plant in Russia's Far East, which is supplying that gas to China, and it is coming at half the price, as I just told you, and it was via a tender that was signed just last week. China is able to secure cheaper supply and resell these shipments to Europe at a profit or at a higher price or at the current prices as well. Earlier, Japan and South Korea were traditionally buying gas or LNG from the Sakhalin terminal, and now it has been sourced to China via the new tender. And Japan and South Korea, they have stopped buying LNG LNG from Russia from this particular plant since the Ukraine war broke out. Now, China's LNG imports from Russia surged to highest level in last 2 years, which happened in the month of August, and Chinese importers have diverted cargoes to Europe at a hefty profit. So interesting things that China is able to profit a lot with the gas economy and whatever is happening with Russia and Ukraine crisis as we speak.
All right, Sonal, thanks a lot for that. So interesting things indeed happening. As we speak, interesting things happening in the market as well. Meandering around that 17,740 mark. The mid-cap index, on an index standpoint, is underperforming today. But we do have a lot of these fertilizer stocks which are surging. Chambal Fert, for instance, has now moved to the high point of trade. Then you do have, a couple of other stocks too gaining. Naveen Fluorine, we have GNFC, IDFC, JK Cement, all of them buzzing around. So what we'll do is take a short break, come back on the other side. We talk about the market technicals with Jay Thakkar, and he'll also give us some trading strategies. Welcome back. 17,750 is where we are on the Nifty. It is also weekly options expiry. So just let's take a look at a couple of these strikes which are extremely active. The most active on the downside is the 17,700 put, which as we speak has added almost 1 crore shares in open interest for a premium of 20 rupees. So maybe the bulls believe that this 17,700 mark is their area of support. 20 rupees premium would mean that, they're looking at strong support between 17,680 and 17,700. And on the way up, the bears believe that 17,800 is their stronghold because the 81 lakh share open interest addition that we've seen on the 17,800 call, 82 lakhs as we speak, for a premium of 20 odd rupees. So the broad range that perhaps the street is looking at is between 17,680 to 17,820, and that is corroborated by the strike prices that we're seeing in terms of the options for 17,750 call as well as put together as well. Where do we go from here? Jay Thakkar of Marwadi Shares and Finance joins in now. Jay, above 17,750 is where we faced resistance at least thrice in the last 3 weeks. What is your sense? Where do we go from here?
Hi, very good afternoon to you, Mangalam. As you rightly pointed out that, 17,800 from the expiry point of view, weekly expiry point of view, definitely we know will, act as a very crucial resistance going forward for, in the rest of the day. And if those levels get taken off, then the probability of upside from thereafter, 17,950 to 18,000 levels looks quite visible. And I think the probability of a breakout is high, if not today, Mangalam, then tomorrow. Because interestingly, if you look at the Bank Nifty data, like 17,800 on Nifty, Bank Nifty had a strong resistance at 40,000 levels, and we have been seeing now that it's comfortably trading above those levels, and in fact it's now inching towards 40,100, or it's trading above those levels as well as far as the spot levels are concerned. And Mangal, above the levels of 40,000, Mangal, I think that Bank Nifty is now headed towards 40,500 on the immediate basis, and thereafter 41,000. So these levels on Bank Nifty were very crucial, and that might help Nifty in fact to take off 17,800. So I have 2 buy recommendations, out of which one is from the banking pack, and that's on ICICI Bank. I mean, definitely the stock has broken out from a nice consolidation which had taken a form of a triangular pattern as well. Technically, stock looks quite positive. The momentum is likely to come back into the buy mode, at least in the short term. And on the immediate basis, the very short term indicators have already given a buy crossover. So one can buy ICICI Bank with a stop loss of 887, targeting 910 and 922 on the upside on the immediate basis. And the second buy recommendation, Mangalam, is on Ultratech Cement. Now, since past 2 days, we have been seeing that cement was really, cement sector overall was performing quite well, and mostly all the stocks have, run up quite a lot. But Ultratech Cement have clearly provided a breakout in yesterday's trading session, and it's, we are seeing some good follow-up buying happening in today's session as well. This stock has provided a breakout from a rectangular pattern, and the range earlier was of almost 400 points. So above the levels of 6,800, we can see the levels of 7,300, which would be near-term target. So one can buy Ultratech targeting 7,300 and placing a stop loss at 67.75. So the risk reward is here too is quite in favor of the bulls.
Okay, ICICI Bank has been one of the strongest stocks this year, sitting at a fresh 52-week high. As we speak, the stock is now up almost 22% this year. It's a big move for a large cap like ICICI Bank. But thanks a lot, Jeff, for joining in. Let's slip into a quick break. Up next, the newly appointed Starbucks CEO Lakshman Narasimhan tells CNBC that growth opportunities are unlimited. Excerpts from the conversation with Lakshman and the Starbucks founder Howard Schultz follows after this short break. Welcome back to Halftime Report on CNBC-TV18. Just days after he was appointed as the new CEO of Starbucks, Lakshman Narasimhan says he is ready for the top job. He sat down with CNBC for an exclusive interview along with the iconic founder of Starbucks himself, and he said that he's looking forward to going on a tour of the Starbucks outlets across the US to understand the company's culture. He also said that the opportunity for growth is limitless. Take a look.
I don't know if you can answer this honestly. What is the part that you're worried about most? This is a big job for you.
Sure. I think, first of all, it's a very special company. Nothing in my past could fully prepare me for it. But at the same time, a lot of things that I've done in the past that I could bring to bear for this company. The one thing that I wanted to be sure of is that, that there would be investments made in order for us to renew the partner experience, in order for us to rethink the customer experience. And some of the things Howard has done ever since he's come in terms of some of the bold decisions he's made me actually a lot more comfortable. So I'm at peace.
How is this going to be different than last time, as they say, Howard? And the reason I ask is there have been periods where you have left Starbucks, you've appointed a new CEO. For whatever reason, it didn't work out, and you decided you had to come back.
Yeah.
That's now happened twice. Why is this different?
Well, first off, I'll tell you why it's different. I am never coming back again because we found the right person. But the ambition of Starbucks is much grander than ever before. And the leadership team, coupled with Laxman's leadership, it's much different than ever before. Also, in 2008, when I did come back, Starbucks was in a much different position. We did not have demand in our stores. We have record demand today. Laxman's coming in with the wind at his back. And so the growth of the company, the equity of the brand, the significant position that Starbucks occupies in China is very, very different. But, Andrew, I'm not coming back a third time. Laxman is here. I'm here to support him. And as I said before, we found a #1 draft choice, the best possible candidate in the world to lead Starbucks.
You're going to put on the green apron and get behind? You've done it already? How are your barista skills?
Oh, you know what? I've got 30 hours of barista training. I'm quite nervous about. It's the thing I'm most nervous about because I want to do that really well. And so, yes.
Hold on, you've had 30 hours of training already?
No.
You have to
I'm going to, when I come in and do
Okay.
this program of immersion, it's 30 hours of barista training, which I'm going to be going through.
How big Starbucks in India now?
350 stores in India. You should say what happened about the announcement in India.
Oh, there've been many, many memes. I've had many suggestions like you would not believe.
What kind of memes? What are we talking about?
And we're talking about,
No, how proud people have been.
But the memes being new coffee?
Well, I've got a lot of suggestions. A lot of suggestions of what I need to do.
Okay, well.
I come from the hometown of Pune, where all the stores close from 1 to 4, and they've been telling me that I should shut all stores from 1 to 4 in honor of my hometown. That's not happening, by the way.
So record demand in the US, and I think customization in India would be what, masala chai.
They do have a chai tea latte.
Yeah,
they
chai tea latte. But I'm talking about your
filter.
proper masala chai or maybe even filter coffee.
I think the best customization they can do is spell all the names correctly. And they should start with his name itself, Lakshman Narasimhan. Imagine he coming to a store and...
But you know what? Really envious job, right? The first thing he's going to do is visit all the Starbucks stores or try and do that in the US and the iconic stores over there. I mean, I would want to sort of go there for that tour.
30 hours of training is what he said.
No, it's 30 hours for him to go into training for that.
Training.
So, yeah, and by the way, all these consumer companies out there do have their own institutes. So, for instance, McDonald's has an institute called the Hamburger Institute where people go take the training of everything that's taking place out there. I would love to study there, honestly, but for now, what we'll do is just take a short break.
Maybe a cup of coffee on the other side. We have Manisha, in fact, joining in. Let's see what she's talking about today and whether agri-commodities is also on her list. But no, it's metals. We'll be back in just a minute. Stay tuned.
Welcome back. And the international markets have an event-heavy day today. You have the ECB monetary policy meeting, and you also have the U.S. Fed Chairman Powell's speech at the Cato Institute conference as well. And ahead of that, we have seen some pause in the US dollar rally and a bit of a gain, as you can see on the gold international prices there as well. Joining us now then is Chirag Sheth. He's Principal Consultant South Asia at Metal Focus. Chirag, hi, important day, and we are looking at choppy asset classes today, including gold and silver prices also. How do you read the kind of events that are slated today and tomorrow and the kind of impact that we can see on the prices?
Good afternoon, Manisha. I think the way I see the market is that over the next, maybe 10, 12 days, you will see a bit of volatility in run-up to the Fed's meeting, because you've had a situation where, post the Jackson Hole meeting, while Fed was hawkish, the street was probably discounting the 75 basis point hike with the Fed, kind of underlined. However, the street was expecting that it could be a 50 basis point hike. And then now again, there is a bit of repricing happening where, the street is looking at 75 basis points again. So, at this moment, there is still a lot of lack of clarity on what the Fed would do. While the Fed has maintained hawkish stance, people are still on the sidelines and wait and watch. And thus, I believe that there is likely to be a lot of volatility over the next couple of weeks.
Right. We are $350 per ounce off the kind of highs that we've seen in this year. I mean, would you see these as lucrative levels to buy, or there still is a risk of further downside in prices?
So look, Manisha, as you're aware, we've been, saying that gold and silver both are headed lower for quite some time, and we maintain our stance on that. While, if somebody is looking at, tactical, kind of investment in the short term, then yes, after such a drop, you may see a bit of bounce back. However, for long-term investors, I think a bit of wait and watch strategy would do well, as we believe that, prices could still head lower.
Okay. Would you say, Chirag, that the lower prices actually have worked well for Indian markets, because we're heading into festivities and weddings as well, and prices do look lucrative, whether it is gold and silver. What is the kind of demand or import pattern that you have seen in this year until now?
Surely, in a sense, if you look at it, the lower prices, while would have benefited Indian market much more had it not been rupee depreciation and that 5%, increase in import duty. And that's why we are seeing a very, very different trend in gold and silver, While silver market has seen a tremendous increase in demand. In fact, in the month of July, we had record imports of about 1,750 tons, and our estimates are there in the month of August, we could have had at least 1,000 tons coming in. So silver is seeing a lot of restocking, a lot of investor interest. However, gold imports, have been still fairly muted because, gold demand still has not picked up. However, we believe that over the next 10 to 15 days time, once we enter into Navratri, Dussehra, and then long festival wedding season, we could see uptick in demand. But at this moment, demand for silver is far more robust than gold.
And clearly, the numbers that we've put out do show that. But Chirag, also talk to us about the kind of demand that we are seeing on ground in Indian markets. The import numbers do look well. All this buying that we are seeing in the Indian markets, is it more physical? Is it investment? Is it jewelry? Is it coming via ETFs or bonds? Where do you see money being spent?
I think for silver, Malaysia, there is two types of demand. One is the restocking by the trade. You would recollect that, about prior to COVID, India had imported a lot of silver. There was a lot of demand coming in, and then suddenly when COVID hit, the silver market literally collapsed. So a lot of these manufacturers, retailers were very, very cautious in building up inventory. And now with, COVID behind us and, economic recovery strong, we are seeing a bit of restocking coming in. Also at lower prices, because silver prices have corrected sharply and there is always this positive interest among the Indian investors in silver, we are seeing a lot of investment demand coming in. In terms of gold, I think the demand is still very muted, and you are seeing probably demand from manufacturers and retailers who are building up their inventory ahead of the festive season, not so much so from the consumers.
All right. So between gold and silver, silver is your better bet there, and we have seen higher imports. And while the price volatility is there, the returns that we've seen in case of silver prices also perhaps seems to be on the higher side. Chirag, thank you as always for joining us and talking to us about the precious metals there. With that, that's all the time we have on the show. Stay tuned. Business Lunch is coming up next.